Most people enter trading with one picture in their mind: profit, fast money, freedom. Very few people enter trading prepared for losses. And this is where the real problem begins. Losses are not a mistake in trading. Losses are a requirement of trading. If you do not accept losses, trading will break you emotionally, mentally, and financially. A losing trade does not mean you are a bad trader. It means you are participating in a probability-based business. Trading is not a job where effort guarantees results. Trading is not a business where hard work today gives profit tomorrow. Trading is a game of uncertainty, and the price you pay to stay in the game is losses. The moment you try to avoid losses completely, you start making emotional decisions. You move stop losses. You overtrade. You revenge trade. You increase lot size. You stop following your plan. Losses hurt not because of money. Losses hurt because of expectations. You expected the market to respect your analysis. You expected price to move in your direction. You expected to be right. But the market does not care about expectations. The market does not know who you are. The market does not reward hope, confidence, or effort. The market only responds to probability. A professional trader does not ask, "Will this trade win?" A professional trader asks, "If I take this setup 100 times, will it be profitable?" This shift in thinking changes everything. Most beginners attach emotions to every single trade. They feel happy when a trade wins. They feel angry or depressed when a trade loses. Professionals detach themselves from single outcomes. They judge performance over series, not moments. One trade means nothing. 10 trades mean something. 100 trades tell the truth. If one loss affects your mood, your confidence, or your next decision, it means you are risking too much emotionally or financially. Good traders focus on process, not outcome. The process includes waiting for the right setup, managing risk, accepting stop losses, following rules, staying consistent. When you follow the process, outcomes become secondary. Losses are part of paying rent in the trading business. You do not get angry at rent. You plan for it. The same way losses should be planned, accepted, and controlled. If your strategy requires a 1-to risk-to-reward ratio, then losses are expected. If your win rate is 40-50%, losses are expected. If you trade breakouts, pullbacks, or reversals, losses are expected. The problem is not losing. The problem is not being prepared to lose. Most traders blow accounts not because their strategy is bad, but because their mindset collapses after a loss. They start trading emotionally instead of logically. Here is a hard truth. If you cannot handle small losses, you do not deserve big profits. Big profits come from patience, discipline, and emotional control, not from prediction. Another mistake traders make is personalizing losses. They say, "I was wrong. I failed. My analysis was useless." This thinking is dangerous. A trade can be correct in execution and still lose. A trade can be wrong in execution and still win. Winning does not mean you did the right thing. Losing does not mean you did the wrong thing. Only rule following defines whether you traded correctly. If your entry was according to plan, your stop loss was respected, your risk was controlled, then the trade was successful even if it lost money. Yes, this sounds strange, but this is professional thinking. Your job as a trader is not to win every trade. Your job is to execute your system perfectly. Money is a byproduct of discipline. Another important mindset shift is understanding time. Trading rewards patience over intelligence. Smart traders lose money because they cannot wait. Simple traders make money because they follow rules. Waiting is not inactivity. Waiting is discipline. Not trading is also a decision. Sometimes the best trade is no trade. If you feel pressure to trade every day, you are not trading, you are gambling. The market will be here tomorrow. Opportunities never end. But your capital can end if you rush. A calm trader survives longer than an aggressive trader. And survival is everything. Because only traders who survive long enough get a chance to become profitable. This is why mindset matters more than strategy. Two traders can use the same setup. One survives, one fails. The difference is not charts. The difference is emotional control. In the next part, we will go deeper into how fear and greed control traders, why revenge trading happens, how to reset your mind after a loss, how professionals stay calm after drawdowns. In part 1, we talked about losses and why they are a normal part of trading. Now we will talk about the two strongest emotions that destroy traders, fear and greed. Fear and greed are always present in the market. They do not disappear with experience. Even professional traders feel fear and greed. The difference is simple. Beginners react to emotions. Professionals manage emotions. Fear usually appears after losses. Greed usually appears after wins. Fear makes you hesitate. Greed makes you rush. Both are dangerous. Let us start with fear. Fear enters when a trader starts protecting money emotionally instead of logically. You start thinking about the loss before it happens. You imagine the stop loss being hit. You imagine regret. Because of fear, you miss good setups. You close trades too early. You move stop losses. You avoid valid entries. Fear does not protect your account. Fear slowly kills your confidence. Many traders say, "I am afraid to enter." This fear usually comes from 3 reasons. First reason, trading too big. If your lot size is too large, fear is natural. Your mind knows one loss will hurt. Second reason, lack of trust in your system. If you are not confident in your strategy, fear will always be present. Third reason, emotional attachment to money. When money becomes emotional, fear becomes powerful. The solution to fear is not courage. The solution to fear is structure. When you know your risk is small, your stop loss is fixed, your strategy is tested, fear becomes weaker. Fear does not disappear overnight. It fades slowly as discipline increases. Now let us talk about greed. Greed is more dangerous than fear because greed feels good. Fear feels painful, so people try to avoid it. Greed feels exciting, so people chase it. Greed appears after winning trades. You start feeling confident. You start feeling smart. You think you understand the market. Because of greed, you increase lot size suddenly. You overtrade. You ignore rules. You take low-quality setups. Greed tells you, take one more trade. Double the lot. This move will continue. Greed makes you forget probabilities. Many accounts are blown not after losses, but after winning streaks. A trader wins 3 trades in a row. Confidence turns into overconfidence. Overconfidence turns into carelessness. Then one big loss wipes out everything. Greed is controlled by rules, not by motivation. If your system says, maximum trades per day, follow it. Fixed lot size, respect it. Stop after daily loss, stop. Rules protect you from yourself. Now let us talk about discipline. Discipline is not motivation. Discipline is not excitement. Discipline is boring. And that is why most people fail. Discipline means doing the same thing again and again, even when you feel nothing. No excitement, no rush, no fear. A disciplined trader looks boring from outside. But boring traders survive. Discipline shows in small things. Waiting for candle close, not entering late, accepting stop loss, not chasing price. Discipline is built through repetition. You do not become disciplined by watching videos. You become disciplined by following rules daily. Another important topic is revenge trading. Revenge trading happens when a trader tries to recover a loss emotionally. You lose a trade. You feel anger. You feel frustration. You feel the need to prove yourself. Then you take another trade without confirmation. Revenge trading is not about money. It is about ego. Your ego wants to win back control. The market punishes ego. The best rule after a loss is simple: pause. Stand up. Take a break. Look away from charts. A loss does not need a response. It needs acceptance. The market does not owe you anything. Now let us talk about drawdowns. Every trader faces drawdowns. Even the best traders in the world. A drawdown does not mean your strategy stopped working. It means probability is playing its role. Drawdowns become dangerous when traders change systems too quickly. They say this strategy is bad. Let me try something new. They jump from system to system. This creates confusion. Consistency matters more than perfection. If your system worked in the past and you followed rules, trust the process. Do not increase risk to recover faster. That makes drawdowns deeper. Lower risk during drawdowns. Protect capital. Capital is oxygen in trading. Without oxygen, you are finished. Another mindset mistake traders make is comparing themselves to others. Social media shows profits, rarely shows losses. Comparison creates pressure. Pressure creates mistakes. Your journey is personal. Your pace is your own. Focus on your rules, not on someone else's results. Now let us talk about patience again. Patience is not waiting randomly. Patience is waiting with purpose. You wait because your setup is not there. You wait because conditions are not right. Patience saves capital. Impatience feeds brokers. If you feel bored, it is okay. Boredom is safer than excitement. A calm trader sees clearly. An emotional trader sees noise. Your job is not to trade often. Your job is to trade well. Some days you will not trade. Some weeks will be slow. This is normal. Trading rewards people who can wait. Finally, let us talk about mindset growth. Mindset does not change in one day. It changes slowly with awareness. Every loss teaches something. Every mistake shows weakness. Do not hide from mistakes. Study them. A trading journal is not for entries. It is for behavior. Write how you felt, why you entered, why you exited, whether you followed rules. This builds self-awareness. Self-awareness builds control. Control builds consistency. Consistency builds profits. In the next part, we will talk about confidence without ego, building trust in your system, long-term thinking, trading as a business, not excitement. In part 2, we talked about fear, greed, discipline, and emotional control. Now we will talk about confidence, long-term thinking, and how to treat trading as a business. Many traders confuse confidence with ego. They are not the same. Confidence is quiet. Ego is loud. Confidence comes from preparation. Ego comes from temporary results. A confident trader trusts the process. An ego-driven trader trusts recent wins. Confidence means you can take a loss and stay calm. Ego means a loss hurts your identity. If a losing trade makes you angry, it means ego is involved. Professional traders remove ego from decisions. They let rules decide. Confidence is built slowly, not from one big win, not from one lucky trade. Confidence comes from repetition. When you follow the same rules, use the same risk, take the same setups, your mind starts trusting the process. You stop questioning every trade. You stop overthinking. Confidence grows when you prove to yourself that you can be disciplined. Another important mindset shift is long-term thinking. Most traders think short-term. They think in days. They think in single trades. Professionals think in months and years. One losing day means nothing. One losing week means nothing. What matters is survival and consistency. If you focus too much on daily results, you will make emotional decisions. Daily results are noise. Monthly performance shows direction. Yearly performance shows truth. Trading rewards people who can stay patient for a long time. This is why many intelligent people fail in trading. They want fast results. Trading is slow money for fast thinkers, and fast money for patient thinkers. Long-term thinking removes pressure. When you know, I will trade the system for the next 6 months, you stop reacting emotionally to short-term outcomes. Now let us talk about trading as a business. Trading is not entertainment. Trading is not excitement. Trading is not a competition. Trading is a business. And every business has expenses, risk, uncertain income. Losses are expenses. Drawdowns are normal cycles. Profits come in phases. If you treat trading like a business, you stop taking losses personally. A shop owner does not close the shop after one bad day. A business owner does not panic after slow sales. They adjust, review, and continue. Traders should do the same. Another mistake traders make is changing rules too often. They change stop losses. They change targets. They change time frames. This creates inconsistency. A system needs time to show results. If you keep changing variables, you will never know what works. Stability builds clarity. Now let us talk about trust. You cannot succeed in trading if you do not trust your system. Trust does not mean blind belief. Trust comes from testing and experience. Backtesting builds logic. Forward testing builds emotional trust. The more you see the same setup play out, the more confidence you gain. If you skip trades, you break trust. If you break rules, you break trust. Then you start doubting yourself. Trust is fragile in trading. Protect it. Another important topic is patience with yourself. Many traders are hard on themselves. They expect perfection. They say, I should not make mistakes. I should already be profitable. This creates frustration. Mistakes are part of growth. Every trader makes mistakes. The goal is not 0 mistakes. The goal is fewer repeated mistakes. Progress is slow, but slow progress is real progress. Now let us talk about discipline during good times. Most traders think discipline is needed after losses, but discipline is most important after wins. Winning creates confidence. Confidence can create carelessness. After wins, stick to same risk. Stick to same rule. Do not increase size emotionally. Winning is not permission to break rules. Consistency matters more than excitement. Another important habit is routine. Professional traders have routines. They analyze at specific times, trade specific sessions, review trades regularly. Random trading creates random results. Routine creates stability. Your brain performs better with structure. Now let us talk about mental resets. There will be days when you feel tired. There will be days when emotions are high. On those days, it is okay to step away. Not trading is part of trading. A rested mind makes better decisions. Forcing trades creates mistakes. Listen to your mental state. Finally, let us talk about responsibility. In trading, everything is your responsibility. No one forced you to enter. No one forced you to risk. Blaming the market keeps you weak. Taking responsibility makes you strong. When you accept full responsibility, you gain control. Control leads to consistency. Consistency leads to growth. Trading success is not about being right. It is about being disciplined. It is not about predicting the market. It is about managing yourself. The market tests your patience. Your emotions test your discipline. Those who master themselves eventually master trading. In this final part, we will connect everything together. Losses, fear, greed, discipline, confidence, long-term thinking. All of these are not separate topics. They are parts of one mindset. A professional trader does not look for excitement. A professional trader looks for consistency. Consistency is not about winning every day. Consistency is about showing up with the same behavior every day. Most traders quit not because trading is impossible, but because they cannot handle uncertainty. Humans like certainty. Trading offers none. The moment you accept uncertainty, trading becomes easier. You stop fighting the market. You stop forcing trades. You stop expecting control. Instead, you focus on what you can control. You can control risk, entries, exit, behavior. You cannot control outcomes. Professional traders accept this fully. This acceptance removes stress. Now let us talk about a complete mindset framework. A strong trading mindset is built on 5 pillars. First pillar, acceptance of losses. Losses are not failures. Losses are information. Every loss shows market condition, strategy behavior, emotional reaction. When you accept losses, you stop reacting emotionally. Second pillar, risk control. Risk control is not optional. It is survival. Small risk keeps emotions small. Big risk creates emotional chaos. If one loss can ruin your day, your risk is too big. Professional traders think in percentages, not money. Third pillar, discipline. Discipline is following rules even when you do not feel like it. Discipline means no impulsive entries, no revenge trading, no rule breaking. Discipline is not talent. It is a habit. Habits are built daily. Fourth pillar, patience. Patience is waiting without frustration. Patience means you trust the process. Impatience is a sign of insecurity. If you rush, it means you doubt your future. Patience shows confidence. Fifth pillar, responsibility. Everything in trading is your responsibility. Wins are your responsibility. Losses are your responsibility. Blame removes power. Responsibility gives control. When these 5 pillars are strong, mindset becomes stable. Now let us talk about consistency. Consistency is not about results. Consistency is about behavior. If your behavior changes daily, your results will also change daily. Consistent traders do boring things. They trade same setups, use same risk, follow same routine. Boring behavior creates stable results. Excitement creates mistakes. Many traders think success will feel exciting. In reality, success feels calm. A calm trader makes better decisions. Now let us talk about why most traders quit. They quit because they expect fast results. They risk too much. They take losses personally. They compare themselves to others. They quit when reality does not match expectations. Trading exposes weaknesses. Fear, impatience, ego. Most people do not want to face these things. But trading does not care about comfort. Trading rewards self-awareness. Those who grow internally survive externally. Now let us talk about thinking like a professional trader. Professional traders do not chase money. They focus on execution. They do not ask, how much can I make today? They ask, did I follow my rules today? This question changes everything. A professional trader can have a losing day and still feel successful. Because success is measured by discipline. Professionals also understand cycles. There are good months, slow month, drawdown periods. They do not panic during slow periods. They stay consistent. They know performance comes in waves. Now let us talk about mental strength. Mental strength is not forcing positivity. Mental strength is staying neutral. Neutral thinking allows clarity. Extreme emotions block logic. The calmer you are, the clearer you see. Trading is a mirror. It reflects your patience, your discipline, your emotional control. You cannot hide from it. That is why trading changes people. If you respect the process, trading builds discipline. If you fight the process, trading creates pain. Finally, let us talk about growth. Growth in trading is slow. But slow growth is strong growth. There is no shortcut to discipline, no shortcut to patience. Every day you follow rules. You move forward, even if money does not grow yet. Your mindset is growing, and mindset comes before money. Those who quit early never see results. Those who stay disciplined long enough eventually do. Trading success is not about intelligence. It is about emotional maturity. If you can control yourself, you can survive. If you survive long enough, you can become profitable. The market does not reward perfection. It rewards consistency. Master your behavior. The results will follow.